I had to start investing from zero in 2026. No rich parents. No insider knowledge. No six-figure salary. Just a normal income. Here's exactly what I would do. Because the world is different now. Markets move faster. AI is changing industries. Inflation is unpredictable. And mistakes are more expensive than ever. So if I was starting today, I wouldn't chase hype. I wouldn't gamble on trends. And I definitely wouldn't copy random influencers. I would follow a simple, calculated plan. Let me show you what that plan looks like. The first thing I would do in 2026 is not invest. Yes, you heard that right. Before putting a single dollar into the market, I would build financial stability. Because investing without stability is gambling. So step 1, emergency protection. I would save at least 3 to 6 months of essential expenses. Not luxury expenses. Not entertainment. Just survival costs. Rent. Food. Utilities. Basic transport. Why? Because markets go up and down. And if you are forced to sell your investments during a crash just to pay bills, you lose twice. Once from the market. And once from fear. The second thing I would do is eliminate high-interest debt. Credit card debt. Unnecessary loans. Anything charging double-digit interest. Because no investment consistently beats 18 to 25% interest. Paying off high-interest debt is a guaranteed return. And guaranteed returns are rare in investing. Only after stability and debt control would I move to the market. Not with excitement. Not with emotion. But with a clear plan. Because in 2026, discipline matters more than enthusiasm. And investing starts with protection, not profit. Once my emergency fund was ready and high-interest debt was gone, only then would I start investing. And I would keep it simple. In 2026, I would not try to beat the market. I would try to build steady ownership. That means I would start with broad market index funds or ETFs that track the overall economy instead of picking random individual stocks. In the United States, that could mean an S&P 500 index fund. In the UK or Europe, it could mean a global index fund that spreads risk across multiple countries. The reason is simple: diversification protects beginners from catastrophic mistakes. When you buy the whole market, you are not betting on one company. You are betting on economic growth itself. I would automate my investments monthly, even if the amount was small. Consistency beats intensity in investing. Trying to perfectly time the market usually leads to hesitation and regret. Instead of waiting for the perfect dip, I would use dollar cost averaging, investing a fixed amount every month regardless of headlines. This removes emotion from the equation. Markets will rise and fall, but over long periods, disciplined investors benefit from compounding. I would focus on low fees, long-term holding, and ignoring daily noise. Because in 2026, information is everywhere, but clarity is rare. And clarity comes from simplicity. After building a core position in broad market index funds, the next step I would take in 2026 is smart allocation. Not aggressive. Not reckless. Just balanced. Because investing is not only about growth, it is also about managing risk. I would divide my investments based on risk tolerance and time horizon. If I am young and investing for the long term, I might keep a higher percentage in equities and a smaller portion in safer assets like bonds or money market funds. If I am closer to retirement or need stability, I would increase defensive assets. The goal is not maximum returns every year, the goal is survival during downturns. Many investors fail not because they choose bad assets, but because they panic during crashes. So I would build a portfolio that allows me to sleep peacefully even when markets fall. I would also consider geographic diversification, not putting all my money in one country's economy. Global exposure reduces dependency on one system. In 2026, economies are interconnected, and spreading risk across regions adds resilience. Investing is not about excitement. It is about endurance. And endurance comes from intelligent allocation. Once my core portfolio and allocation were in place, only then would I consider calculated growth opportunities. In 2026, ignoring innovation would be a mistake, but chasing hype would be worse. So instead of betting everything on trending stocks or viral assets, I would allocate a small percentage of my portfolio to high-growth sectors. Areas like artificial intelligence, clean energy, cybersecurity, and digital infrastructure are shaping the next decade. But I would approach them through diversified ETFs or carefully researched companies, not speculation. The key is position sizing. Maybe 10 to 15% of my total portfolio at most. Enough to benefit from innovation, but not enough to destroy stability if volatility hits. I would avoid emotional investing driven by social media excitement. Markets reward patience, not urgency. At the same time, I would continuously invest in myself. Because the highest return asset in 2026 is skill. Learning new tools, understanding technology, and increasing earning capacity multiplies investing power. Financial growth does not come only from markets. It comes from increasing income and investing wisely. The smartest investors combine capital growth with personal growth. That balance creates long-term advantage. If I were starting investing in 2026, I would focus less on getting rich fast and more on building control. Because real wealth is not about sudden gains, it is about long-term freedom. I would stay consistent during market crashes, ignore daily noise, and avoid comparing my journey to others online. I would review my portfolio once or twice a year, rebalance when necessary, and keep emotions out of decisions. Most people fail in investing not because they lack intelligence, but because they lack discipline. Markets reward patience, not excitement. In 2026, information is unlimited, but clarity is rare. So I would keep my strategy simple, automated, diversified, and long-term. I would protect my downside, invest consistently, and allow compounding to do the heavy lifting. Because the goal is not to impress people with risky bets, the goal is to quietly build assets that grow while I sleep. If you start with stability, invest with discipline, and think in decades instead of weeks, you don't need to predict the future. You just need to participate in it consistently. And that is exactly how I would start investing in 2026.